With all of the ridiculous news stories that we've been seeing recently about how there's no recession, there's no banking crisis, and there's nothing that anyone should worry about, and the housing market's already bottomed out and it's going to make a full recovery, I was actually happy to see this great story today from Business Insider, which I'm taking a lot of this from them, guys, so it's not like I'm some sort of genius here that just invented all of this stuff. You know, they have a great story out about how there are several different charts that we can look at that show that the economy is heading into a downward spiral right now. And the way that we can do this is by just looking at these charts and seeing how things reacted in the past. And this is something that my friend Nick from Reventure Consulting, he does this all the time. He puts together different data sets and shows how things played out in the past, which can give us a glimpse into how things might go in the future, which I think is really smart. And that's basically what we're doing in today's video. So let's take a look. This very first chart here that we're looking at is the yield curve, or the gap between the yields on the 3-month Treasury and the 10-year Treasury. Typically, yields on 10-year Treasury notes are higher than those with shorter durations, as investors seek greater compensation over longer durations. But the yields are currently inverted at a deeper level than they have been in the last 40 years. Right now, a 3-month bill yields 4.8%, a 10-year note yields only 3.5%. So what that tells us is investors are completely scared right now. You can get more interest on a short-term Treasury right now than the long-term, because nobody knows where things are going to go. And all those gray lines that you guys can see from the Fred chart are previous recessions, and every single time since the 1960s, yield curve inversion like this has predicted a recession. And what this yield curve inversion means is it means brakes on the economy, okay? It means that you have more and more investors piling into the 10-year Treasury because the future is uncertain. And as more people pile into the 10-year Treasury, it forces the yields to go down. And that's why we're seeing such a massive yield curve inversion right now. The Fed also has their own chart that they use to predict recessions. They have a probability of US recession predicted by the Treasury spread chart here. And what's the first thing you notice, guys? When I looked at this chart, the first thing I noticed is that the odds of a recession, according to this chart right now, are higher than they were in 2008, okay? Higher, not lower, higher. And the only times we can see it higher than that was you have to go way far back into the 70s and 80s to see it climb even higher than it is today. And obviously, this is a complete joke, because most of us know that we've been in a recession for quite some time, and to say that it's not is basically just a cover-up at this point and a lie to make people feel good about spending and that the economy's still great. So if you ask me, so far, just with these two charts, these things already prove to me that we're already in a recession, but there are things that are causing us to feel like it's not in some cases. Like some people are still doing really well, pulling down really good incomes, and can afford this recent inflation that we've had. And depending on where you live, you might be feeling inflation much more than others.
Now this house here is a great example of how sometimes sellers just need to get real. They decided to sell this house back in April of 2022 for $4.5 million. But they just sold it in February of 2023 for 2.7. So as you can see, that is a far cry from what they were originally asking. But if they weren't flexible on that price and didn't come down to the real value, it would still be sitting on the market.
Now the next thing that we can look at is this chart that pretty much shows the volatility in the bond market. And as we can see, once again, it hasn't been this high since 2008. Now it was higher in 2008 than it is right now, but that doesn't mean that it still can't climb even higher and reach those same heights, if not surpass them, in the near future. According to Jim Bianco, who is the founder of the market research firm Bianco Research, who put this chart together, they're saying the reason for this is because it's so uncertain of what the Fed's going to do at their next meeting that it's just causing all kinds of trouble right now, because really nobody knows. But if you listen to what Jerome Powell has said time and time again, it's that the interest rate hikes are going to continue until inflation's under control. So I'm not sure why it's so hard to guess what's going to happen, because they flat out told us what's going to happen. But hey, I think these guys are just constantly praying for a faster and better recovery than just going into, a full-on recession. And Jim even says, guys, back to our credit crunch, this uncertainty is a result of the bank's growing reluctance to lend out money amid the liquidity scarcity. A large enough pullback in lending is going to send the economy into a downward spiral, guys. And this is something we're already seeing, which we're going to look at here in a couple more charts.
This seller's going to have to learn the same lesson as the previous one. It's another flip. They bought it for $2.1 million back in 2021 and now have it listed for $4 million. And remember, that previous house sold for $2.7 million, and it's just a few doors down. And on top of that, it's bigger than this house. So I don't think there's any chance they're going to be getting anywhere near this amount, but we'll pass by again at some point in the future and see what they actually sell it for, if they sell it.
Because by looking at this next chart here is where things really start to get interesting. This chart that we're looking at from Fred shows the bank's reluctance to lend to businesses. Now, think about what I just said for a minute. You don't have to be an economy expert or business expert to think about what this might do. If businesses that rely heavily on getting credit, having access to loans and lines of credit to conduct their business don't have that, well, what do you think is going to happen with that business? First of all, they might be defaulting on some of their accounts payable. They might not be able to pay some of their vendors. They may have to start laying off employees because they don't have the funds to pay everybody. And they may have to start closing locations if a business has multiple branches and things like this, and do anything they can to start cutting back on the amount of money going out the door each month. And what this chart shows is 45% of banks are tightening their lending standards. In 2020, right after this COVID crisis, it was 71%, which was crazy. And in 2008, it was 83%. So it's definitely not as bad yet as it was during those times. But you guys can see it can easily get there, okay? It's already halfway there. And to just say that there's no way that it could continually go higher is just anyone's guess right now. And what does all this mean for the stock market? Well, it means there's going to be more pain, guys. There's going to be more losses likely throughout the rest of this year as things continue to deteriorate. James Bianco from the research firm that we talked about earlier, he says that he thinks the S&P 500 will bottom out around 3,500, and right now it's around 4,000. Bob Dahl from BlackRock, he said that a mild recession would knock the S&P 500 down to 3,400, while a deep recession like 2008 would sink it down to the 3,000 mark. And then you have John Hussman and Jeremy Grantham, who think we could see it be much worse than that, up to 50% declines from where things are at right now. They're saying things like, this is bigger than 2000 because it includes real estate and bonds, and that one did not. The economy had a gentle recession back then. It had no problem with real estate. It had no problem with markdown of debt. And yet the NASDAQ went down 82%, Amazon went down 92%, and the S&P 500 went down 50%. And that was with a mild recession, guys. And then you just can't help but laugh because, as I'm putting together these stories of the things I'm going to cover in the videos, it's so funny to see things that are just complete contrast from each other. Because we talked about all these things here that are huge warning signs for the economy right now. And then the next story that I see is home prices suddenly jump after several months of declines. Just like this story we talked about last week from the National Association of Realtors. This one's also a joke, but that's why I want to cover this, because after all the things that we just saw, we know that this is a huge sham. Check this out. Home prices nationally rose 0.16%, guys. So you're talking a tenth of 1%, okay? Which is negligible, to say the least. And this is according to Black Knight. They're saying how this is the strongest 1 month gain since May of last year. Like, big whoop, guys. Market's down year over year and is likely to continue to go that way. And we know we saw this slight bump because of mortgage rates going down. And the people who are actually able to get their hands on a good mortgage deal and close on a property are the reason why we saw that small uptick. Because even according to Black Knight's data here, home prices are down 2.6% from the peak of last June. And in this same story, it talks about how, according to the National Association of Realtors, in February, we saw closed sales go up 14.5%. And they're calling this remarkable. And it's for all these reasons that they're saying the housing market has bottomed out and now it's going to be in recovery mode. Well, how can you say that when you just looked at everything we just saw, guys? And all these charts confirm that we're heading into a recession if you don't think that we already are in one. And to avoid one at this point, I don't see how it's possible. Even Black Knight themselves in this article says that they predict that home prices are going to continue to drop throughout the rest of this year. You know, every time that we might see mortgage rates go down, you might see this uptick in the amount of closed sales for the people that can actually still qualify or get a mortgage under these tighter lending standards, but you're not going to see this flood of closings throughout the year. It's just not going to happen under these conditions right now. So if you ask me, guys, all this is, it's just another way to stoke the FOMO fire. You know, you got to remember that these news agencies get paid to put out stories like this to help stoke the FOMO fire and make people think that the market is still red hot and you better jump in now while you still can. And I know there's people out there that will believe that until the day they die, and the best time to buy real estate was, you know, yesterday. Of course, in hindsight, that's always the case, but it only applies to people that hang on to properties long term, guys. And it also only applies if you're financially stable and if you have enough assets and income to weather a severe downturn and hang on to those properties. KPMG, they also came out this week saying how they think that home prices are going to drop an additional 8% this year on the Case-Shiller Home Price Index. Case-Shiller is already down year over year, and they think it's going to drop at least another 8%, and that's just for the year 2023, guys. We're not talking about overall drops, we're talking about just this year. And remember, the Fed wants home values to go down and rents to go down right now, because according to their CPI numbers, this is one of the leading causes of the high inflation right now, is the higher stated rents that they use for the CPI. So that combined with you losing your job, they want to see job losses and they want to see rent prices and home prices come down to help with this inflation equation, which is why I think that they're still not done with the rate hikes. And of course, I could be wrong, guys, it's just a guess. But if they are done, then we know that they were never really serious about getting inflation under control to begin with. And, you know, this whole thing is doomed, essentially. And one thing to note here, they're citing the Case-Shiller Home Price Index data. The Case-Shiller Home Price Index has dropped 5.1%. 7 months in a row, it's been falling. So the most touted and used data to track the housing market is already down by 5%. And if it continues to go down by another 8% for the rest of this year, that's already 13% in about a year and a half, guys. And the Case-Shiller reflected about a 27% home price decrease throughout the last housing crash. And that was over a span of several years. That was not 1 year, okay? And when you look at it from that perspective, you can easily see how we could end up with the same type of 2008 style crash as all these economic problems start to sort themselves out. Now, one last thing to back up pretty much everything we've been covering here so far. The week ending March 22nd, depositors withdrew a whopping $126 billion from the banking system, according to the Federal Reserve data. And interestingly enough, we saw people running and pulling money out of the smaller regional banks, putting it into the larger banks because they thought that's better for them. They're less chance of failing and don't have to worry about their money so much. But interestingly enough, the biggest of the 25 banks lost $90 billion. The smaller banks actually gained back $6 billion. But overall, bank deposits now are down to $17.3 trillion nationwide, which is 4.4% lower than a year ago. So people clearly do not trust the banking system right now, which who could blame them given everything that's been happening. And they're just looking for alternatives, somewhere else to put the money where it might be safer. And this puts a tremendous strain on banks, guys. That's what everybody needs to understand from this. The challenge for banks is that the more people that pull out money, it puts pressure on the banks to give people a higher interest rate for their deposits, which is why you're seeing CDs now that are ranging above the 5% range, and even high interest savings accounts topping around the 4%, because they're trying to retain their deposits. But as they do this, their profitability goes down, and at the same time, if too many people pull out enough money, it puts the banks in a vulnerable position where they need to sell assets at a losses to cover people that are wanting to get all of their money back. And that's why I'm telling you that this banking crisis has really just begun. And it's just another thing that we need to keep an eye on throughout the rest of this year, because there's almost guaranteed to be more developments in this department. So once again, you got to watch out for people coming out and talking about how everything is so beautiful right now and that there's just nothing to worry about, because the real information and the real data paints a very different picture. Go back and reference these charts for yourself. Go to the websites that provide this data and look at these charts for yourself that we covered earlier in the video, so you can see just how vulnerable this entire system is right now. And there's holes being poked in it from almost every single angle. And I don't think it can really go on much longer without having some massive corrections going forward. All the links of the stuff that I talk about in these videos is down in the description below. So if you want to go read some of this stuff in more detail for yourself, it's all there for you to check out. And I suggest you do that if you really want to be in the know. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.